Alrighty, so hi, I'm Donald. No slides. Don't want to torment you. Thank you for making it this far in the day for this esoteric, I guess it was, described concept. Obviously, the tax situation is very fluid at the moment, so everything I'm about to say comes with a giant asterisk that it may change in a week when the members come back from their Thanksgiving break. And I'm going to try to remember to weave in the Sustainable Development Goals in this, which I know is supposed to be a thematic today, and actually has some relationship with tax policy. How many of you love the U.S. tax code? There we go. Excellent. Excellent. I usually get a couple of hands. There is widespread, but not universal, concern that our tax code has lots of problems. And so there have been lots of efforts over the years to do tax reform, which is one of those terms that obviously captures many different possible changes you might make. But there's kind of a general aspiration that, you know, if we all got together and thought carefully about it, you could probably make a tax code that is simpler, that is fairer, and that is more conducive to prosperity and growth, and in particular shared prosperity. So aspirationally, that's what the tax geeks have all been talking about for probably several decades now. And then there's the question about how well Washington is at trying to pursue that. I just want to give you a couple frameworks for thinking about the debate we're having. So the first framework is what on earth we do with our tax code. And there are three basic things we do with the tax code. So the first, not surprising to anybody, is we use it to raise revenue. Right? So the idea is that we raise enough revenue to pay for at least a lot of the spending the federal government undertakes. Not all of it, we persistently run deficits, but that we use it as a way to raise revenue to fund the various things that we want the government to do. The second is distributional concerns. Right, so there's a lot of concern about having high-income folks pay higher tax rates than lower-income folks as a way to kind of, you know, ease some of the economic inequalities that happen, which have become more pronounced over time. And then the third is we do just an enormous amount of social and economic policy through the tax code. Right, so you know, don't think about the tax code as just the kind of green eye shade, you know, your accountant or TurboTax just, you know, extracting money. Think about it as a system by which we create incentives, both incentives and disincentives for people and businesses to do things, to not do other things. It's a way we reallocate resources. And so if you're interested in almost any social economic policy issue, from housing to the environment, to promoting innovation, all those sorts of things, there's almost always a tax angle. And primary reason for that is just, you know, the policymakers on Ways and Means and Finance have realized over the years that by having the power to tax, they have the power to basically touch any part of the economy. And it's just one example of that, which may be familiar to many of you, but is important for everyone to know. The largest cash assistance program that we run in the United States, so the largest thing we do for low and moderate income people, is actually run through the tax code. It's a thing called the Earned Income Tax Credit. It's bigger than any of the cash support that comes out of the spending side of the government. And so think about the tax code really as being this vital tool of social and economic policy, and then, you know, think about how those are going to change as we go through the tax reform discussion. All right, let me start with revenue. So when you go to Washington and you work on these kinds of issues, you need to get jaded about the T word, right? So trillion, right? So trillion will roll off your tongue. So in rough orders of magnitude, we raise about $3.5 trillion a year, and that's on its way up to north of 4 over the next decade. In Washington, we often think in 10-year budget windows. So in rough orders of magnitude, we're raising around $3.5 trillion today. In rough orders of magnitude, we're going to raise $40 trillion in revenue, a little bit more, over the next decade if there aren't any changes. The tax reform discussion started by many of you are old enough to remember a year ago when the tax reform discussion started. It was a discussion literally of revenue neutral tax reform. So it was focusing on the idea of we have problems with our tax system, let's move things around so it's fairer and more conducive to prosperity, but let's not have this be a debate about the size of government or the amount of revenue we're going to collect. And so the idea was revenue neutral tax reform. Okay. The House came up with a proposal that included one feature called the border adjusted tax, which you do not need to remember. It will not be on the test because the retail industry drove a stake through its heart. That raised around $1 trillion. Right, we're going to be cavalier about trillions here, but kind of $1 trillion, $1.5 trillion. So the people in Washington were left wondering, where on earth can we find $1 trillion and $1.5 trillion to do all the other things we want in our tax reform plan? Now, there were some of us, going back to the Sustainable Development Goals, who were standing in the corner and going, ooh, 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 I know, a carbon tax. right? Because a carbon tax, well designed, could raise on the order of $1 trillion, again in nice round numbers, over the next decade, and accomplish many of the reductions in carbon emissions that many of us would like to see accomplished. There are a few random people in Washington who favor that. Most of them meet quietly in private and are not elected. Those who are elected, there are a decent number of Ds, and I think we're up to maybe 3 elected Rs who have talked about doing that, but it's clearly not on the agenda. So the carbon tax people lost, at least thus far. That's not in there. There were a couple other thoughts, but basically, eventually, everyone just threw up their hands. Everyone, when I say things like that, I mostly mean the Republicans, since they are driving this process for reasons I'll get to in a moment, threw up their hands and said, you know what? Revenue neutral tax reform is out. We're now going to do tax reform that loses about $1.5 trillion over the next decade. And so then going back, compare that in your mind to 40 trillion that we're going to raise over the next 10 years, cutting that by $1.5 trillion. So it's kind of somewhere in the neighborhood of a 3% tax cut. So significant amount of money. And that's where we are. So the tax bills you've seen from the House and you've seen from the Senate both lose $1.5 trillion over the next decade. Now, there's a question about how you get things enacted in a world where in the Senate you're subject to filibusters. And so in budget world, there's an answer to this. It's this concept of reconciliation that says under certain conditions, you can pass things in the Senate with only 50 votes. Republicans currently have 52, although that may be precarious. And yes, and it's a very passionate topic. So in the Senate, to do things with the 50 votes, the budget says, yeah, you can cut revenues by $1.5 trillion, but starting in year 11 and there forward, the revenue loss has to be 0. And so the challenge is in the House, they don't have the constraint. They were fine. They passed a bill that would lose $1.5 trillion over the next decade. In the Senate, they've been struggling to design something that would cost $1.5 trillion over the next decade and then cost 0 afterwards. And so one of the things you will see in the tax proposals out there are that a lot of the tax cut portion of the tax reform end up being temporary. In particular, the vast majority of the tax reductions that apply to individuals, to normal human beings, expire after 2025. And one of the reasons, and the primary reason for that is so that you can satisfy this requirement that there's no revenue loss outside the window, outside the 10-year budget window. Republicans are very insistent that many of the major business reforms, in particular lowering the corporate tax rate, be permanent. And so that loses money outside beyond the 10 years. The individual tax cuts are going to be temporary. They still need some additional revenue, and so they've done various things to raise revenue, not from corporations out there. And so there's a tension in this whole debate about, well, do you think things should be permanent? Do you think they should be temporary? And then just note that they're on this trajectory where to satisfy Senate budget rules, they're going to be in a situation where they're going to be giving permanent tax cuts to corporations and only temporary tax cuts to normal human beings. And then normal human beings are going to have to chip in more as you get into later years. So obviously that's a very controversial issue. In rough orders of magnitude, think about the tax plan that's now being discussed as being roughly a $5.5 to $6 trillion tax cut and roughly a $4.5 trillion tax increase for a net loss of $1.5 trillion. The big innovation that the Senate introduced in the last few days was to turn this from being just a tax discussion, which is what we had in the House, and they've now introduced the whole healthcare debate back into it. So the latest Senate bill would eliminate the individual mandate for health insurance, and then one effect of that would be to reduce spending on things like Medicaid and Medicare, as there are some people who would not enroll in those, and so there'll be some reduction in spending. And so you now have a conversation that's actually cutting taxes, raising taxes to offset some of it, reducing spending on things like Medicaid to offset a little bit more, and then having the net $1.5 trillion net budget effect over the next decade. So that's where the budget math is. Now, the politics of that are there are some Republican senators who make noises about not being comfortable with a $1.5 trillion revenue reduction over the next decade. And what we don't know is, well, where's their breaking point? And in particular, in the Senate, you can only lose 2 Republican senators, and so where's the breaking point that people drop off? It is very hard to believe they could do the full $1.5 trillion, but none of them have shown their cards yet to show what they're willing to do. Okay, so that's where we are revenue-wise. We'll come back to distribution. Moving parts. Right, this is incredibly complicated. There are lots of things going on. It was teed up in the introduction. In the famous 1986 reform, there was a process that started in 1981 of the Treasury Department putting together really long reports with options and proposals for how to combine them into, kind of meaningful, well-designed tax reforms. There was lots and lots of discussion, lots of public hearings and whatnot. This process is happening on a more accelerated basis. I mean, there have been plenty of hearings at some level about tax reform generally, so I don't want to say there haven't been any, but the specific things that we've been seeing discussed for the last few weeks are kind of being analyzed in real time by the geek and wonk community. And if you participate in Twitter, what you can see on Twitter are all these tax lawyers out there inventing tax shelters on the fly every morning when they see what the new tax proposals are. And so a concern with the process is how rapidly it's going, and kind of how many moving parts there are and what accidental provisions and loopholes they may create. And now, the beauty of the Thanksgiving week is that I think the tax lawyers and accountants are going to keep doing this while the members go home, and so we'll probably reveal more things that need to be tweaked so that these provisions are not giant new loopholes. Now, so I mentioned the health piece, right? So all of the health politics are now being reintroduced into the tax discussion. On the individual side, right, the normal human being side, the things you ought to know is that there's an effort, obviously, to reduce rates. There's an effort to what's called increase the standard deduction. So the standard deduction is basically thinking about it as the chunk of income that you can earn without having to pay any taxes on it. And so proposals will make that bigger. They'll offset that somewhat by reducing something called personal exemptions. But the net effect of that is that for many people, at least while this persists, right, in the Senate bill, it expires after 2025, but that more people will have income for which they don't face tax. And it also means that fewer people will worry about itemized deductions, right? So they'll devote less efforts to writing off things because they'll have a bigger deduction they can take instead. There are efforts to roll back the mortgage interest deduction, right? For those of you who have mortgages that are more than $500,000 on your home. Currently, you can deduct interest on mortgages up to $1 million, plus possibly another 100,000. So proposals to reduce that. There's this debate about what to do about your ability to deduct state and local taxes. The Senate bill eliminates that entirely. The House bill would let you continue to deduct up to $10,000 in property taxes, but otherwise eliminate it. As you might imagine, that has a lot of blue state, red state dynamics behind it. The blue states, on average, tend to have higher income tax rates in particular. Think California, think New York, and therefore get more of a benefit from the ability to deduct the state taxes. The taxpayers there get more benefit from the ability to deduct their taxes. That's a really big item. That's another one that comes in the $1 trillion range. So that persisting is essential to making the budget math work for these proposals out there. And one of the big questions is whether that really will be stable, whether enough senators will be willing to go along with it, because it's obviously very painful to some states. And then there's at the kind of for low and moderate income folks, although stretching actually fairly significantly up the income scale, one of the more notable items is an expansion of what's called the child credit. So if you're a working family and you have young children, you're eligible for a credit back from the government that in essence offsets income taxes you pay and possibly some of the payroll taxes you pay. So that's something that's designed obviously to help folks who are at the lower end of the income spectrum. Even without that in there, at the moment, the proposals that are out there still deliver more tax reductions to high-income folks than lower-income folks. You've seen this evolution in the proposals the Republicans have been putting forward, where they started off with the vast majority of the benefits going to high-income folks, and they've been becoming more progressive as we've seen the legislative sausage-making going on. An open question there is how far they keep going that direction. I should note the individual income tax is the biggest tax we have, so it collects just about 50% of revenue, and so that's where a lot of the money discussions are. There's a high-profile discussion about what to do with the estate tax. The estate tax is basically rounding error when it comes to money. It's only in the $100 billion, $200 billion range over the next 10 years, which in Washington is a small number. But obviously something that is very live and important in terms of kind of moral considerations and how you think about the intergenerational transfer of wealth. They seem to be on a trajectory where they're going to raise the exemption, raise the amount of estates that don't get taxed at all. House actually proposes eliminating the estate tax, but the Senate's not there, and my guess is they'll just stop at raising the exemption. There's corporate, which I know you guys want to hear about. So corporate, think about corporate income tax as bringing in about 9% of our revenue. Okay, so it's our third largest revenue source. Individual is the biggest. Payroll tax, which is not part of this discussion at all, is the second biggest. Corporate is the third biggest. As you know, Tax rate at the moment is 35% at the federal level, on average about 4% from states. So we have about a 39% on average statutory tax rate on corporate income. No, I'm going to get to effective, yes, right. So 35% statutory, add 4 for the states, so around 39. So we're the highest in the developed world. There was a brief moment a few years ago when Japan was ahead of us, but we're the highest in the developed world. Many other countries in the OECD have top tax rates that are 25 or 20, some are even 15. We're definitely an outlier on the corporate income tax statutory rate, but the effective tax rate point, we also have lots of tax write-offs, right? There are lots of tax breaks that you can take. And so effective rates, people calculate them differently, but for conversational purposes, think of it as being around 20%, 22% on average across corporations, although varies dramatically depending on what business you're in and how you structure yourselves. From a tax policy person's point of view, this is about the worst possible way to design a tax system because it makes taxes incredibly important to corporations. Because it means if you don't tax plan carefully, you face the highest rate in the world. But if you take into account all the various things that are in the tax code, you can get your rate down a lot. And so as a result, you should have a very large tax compliance, tax planning department, of which General Electric has, I believe, the best in the world. Economists have long talked, tax policy people have long talked about, well, can't we bring the rate down, roll back those tax breaks, and have a more efficient system in which tax plays much less role in driving business behavior, so businesses can focus on the economics in business, and we can collect revenue in a more intelligent, efficient way. Aspirationally, that's where we would go. Challenge there, though, is that there's actually a limit to how much money you can raise by rolling back tax breaks. And so my colleagues at the Tax Policy Center at the Urban Institute did an analysis where they said, well, suppose you got rid of every corporate tax break identifiable that you could get rid of. How low could you take the corporate rate? And the answer was 26%. At the moment, the administration, the House, and the Senate want to take the corporate rate down to 20. And so the question is, wow, if you got rid of, hypothetically, all corporate tax breaks, which they're not, you could only get to 26. How on earth are you going to get to 20? And there are two answers to that. So the first answer is you could go beyond the list of things that are perceived as tax breaks and start eliminating other deductions. And the one on that list is interest. Right? So both the House and the Senate proposals would reduce the amount of interest that companies can deduct. Now, in an income tax, allowing corporations, like if it's a corporate profits tax, allowing corporations to deduct interest makes perfect sense, right? Because it's a cost of doing business, it cuts into their profits. However, in a world where we also allow firms to write off their investments quickly, what we call accelerated depreciation, or as in these bills, we let them expense it immediately, right, rather than capitalizing it and spreading that over time and depreciating it. In a world where we let them just write things off immediately, there is a logic to limiting interest deductibility. And so that's the direction that they're going. They have partial limits on it, but it raises a substantial amount of money and helps them get the rate down somewhat, but still is nowhere near enough to let them get it down to 20. And so the other way they get it down to 20, particularly persistently in the future, as I hinted before, is they end up raising taxes on people. Like, not that, obviously corporations, the money ultimately flows through and affects people, right? Don't think of them as being off separate in the cosmos somewhere. But ultimately, individuals are going to have to pay higher taxes if they want to get the rate down to 20. And that's why a lot of people in Washington think that when the sausage is finally ground and comes out at the end, that the rate has got to be higher than 20. The president has said he's not willing to negotiate not a penny more. You've heard similar things from the House and the Senate. But the math and the politics are just really, really tough to get a rate that low. For those of you old enough to remember the 2012 election, you may recall that President Obama wanted to do 28% and Governor Romney wanted to do 25%. And that's kind of the range in which polite tax society has been thinking for most of this discussion. I think Bob Posen last year predicted 22, 23, which is probably like the lower end of the achievable range. Now, maybe they'll be able to get the votes to do 20, but just the math on that are very hard because the bumper sticker ultimately becomes you're cutting taxes on multinational corporations and raising taxes on other folks. And I don't think that's going to survive Thanksgiving, would be my political prediction. So rate's going to come up, but makes perfect sense to have a corporate rate in the United States that begins with a 2 and not a 3. Right? We are definitely an outlier. That's definitely a step in the right direction, assuming you can make the rest of the package look good. There is a whole painfully mind-numbing part of corporate tax that has to do with international tax, right, in the rest of the world and how you tax multinationals, which leaves many a tax expert crying and whimpering in the corner. And so if you ask me about it, I will try not to cry and whimper in the corner. But I would just say that the tax proposals have in them an effort to take our current system, which is a very goofy, neither here nor there system, and try to make it more like what other developed nations do. There are a lot of very hard details in how you do that, and there is no perfect international system, but there is some effort there to do things you would recognize as being real reform to try to kind of modernize the way we treat international taxation and also deal with the $2.5 trillion of earnings that have accumulated overseas. Back to the cocktail party thing, if you want to sound smart in a cocktail party and you're talking about this, do air quotes when you say overseas, because a lot of the overseas money is actually in a bank account in New York. It's just in a bank account in New York with a label on it that says overseas. And then finally, I want to get you guys to torment me with questions, but then finally there's this issue about the pass-throughs. So the vast majority of businesses in the United States are not structured as C corporations, but are structured as partnerships, LLCs, and S corporations. Depending on how you count it, those pass-through entities account actually for more than 50% of business revenue, so they're a significant player on the business landscape. In tax land, we call them pass-throughs because, as those of you who experience these know, they aren't taxed at the entity level typically, right? So they are not sending checks to the IRS. Instead, what happens is they report their income on a K-1 typically, send it to their owners, and then owners incorporate that on their personal taxes. And so the income passes through to their owners, and then their owners pay taxes on it at their personal rates. The politics of this are, if you propose lowering the corporate tax rate from 35 to 20, all the pass-throughs in America go, and what about us, right? They're like, hey, what about us? Don't we deserve a tax cut too? We're job creators, we're businesses. And the politicians feel like they have to respond to that. And so what they've been struggling with is how to respond to that. Republicans of a 15-year-ago vintage or a 10-year-ago vintage response to this would be to say, let's just cut personal income tax rates across the board, and that would lower the tax rate on pass-through income as well as on wages and salaries and interest and other things that are taxed at those rates. The challenge with that is that that costs a lot of money because it's affecting all those different kinds of income. And so now the modern current vintage of Republican thought on this is, well, let's see if we can carve out lower rates for pass-throughs specifically. And the House and the Senate have different ways of trying to do that, but the spirit of that is to say, if you're earning wage and salary income of $1 million, you should still be in the top tax bracket. You should still pay 39.6 in the House bill or 38.5 in the Senate bill, right? And so, just keep on there. But that if you're a business, if you're a pass-through, if you're a job creator, you should be eligible for a lower rate. In the Senate bill, that lower rate would be 25. In the House bill, that lower rate would be 25. In the Senate bill, it's around 31, 32. And the challenge is then how you design that in such a way that it focuses on the businesses that you want to reward and encourage to grow, and that you don't create a giant loophole. Because the classic loophole everyone thinks about is if you create, consider the House bill where the top tax rate on a pass-through is 25 and the top tax rate on earned income is 39.6. Right? Everyone who earns enough to be up there, the people who earn more than 400 grand a year or so, are all going to have a big giant incentive to go LLC themselves. Right? So rather than being an employee of your business, you could be an LLC and contract with your business and provide your services. We have evidence on this point, by the way, from Kansas. Kansas did a permutation of this in their state income tax. They eliminated taxes on pass-throughs, and lo and behold, lots of people pass-through themselves, and there are lots of LLCs that aren't really businesses in the sense you might normally think of them as businesses, but are tax shelters to take advantage of the lower tax rate. And so the debate you're seeing in Washington at the moment is how can you do this, provide this assistance to the pass-throughs, but design it in a way that's narrow enough that you're not creating a giant loophole, and then how can you do it in a way that's sensitive to the fact that businesses are different and that you want to try to tease out who's good, who's bad, and which side of the line people are going to be on. Right? And so the idea at the moment is that services businesses are not going to be eligible for this. So the attorneys and accountants of the world are not going to be able to get this favorable rate because even if they LLC themselves, they're still the moral equivalent of wage and salary earners, at least politically. But it's a very hard thing to do. And this is a good one if you are into Twitter, into tax lawyers, you can go on and just watch them design loopholes to get around this. right? So there's lots of, well, if the lawyers aren't eligible, well, then they should buy the building they have their offices in and then charge themselves exorbitant rent. And then they, as lawyers, don't make very much money, but hey, their business over here owning rental property is earning vast profits that are taxed at 25. And you can just imagine the arms race, right, of kind of how you solve this problem. And it's something that the tax geeks all dislike. So all the tax geeks are pretty much universal of don't provide any special pass-through tax break. It's just an invitation to tormenting us with non-economic, meaningless things, just tax them at the personal rate. But there's this enormous political pressure to do something for the pass-throughs to balance out the reductions that are happening on the corporate side. And so that's a giant question mark as to how it resolves. I'll stop filibustering at that point and we'll see what's of interest to the audience, besides the cheese. Yes? Oh.
Sure. We're trying to record it too. So. Yeah, it's my fault.
So everyone's been referring back to Jeremy Grantham's talk from last time. And among the other things he talked about was all the terrible things that come along with inequality in a society. So I was just curious about what these tax changes might do to income and wealth inequality.
So this has been an evolving issue. Again, the plans, oh, I'm sorry, there's a camera. And here I am being Phil Donahue, for those old enough to remember Phil Donahue. So the plans in the early stages were just very clearly tilted to providing tax cuts for high-end people, cutting the corporate tax rate, cutting corporate taxes. Some of that goes to benefit workers in general, but a lot of it's concentrated at the high end. Special pass-through tax rate obviously benefits folks who have pass-throughs. The income with them tends to skew high income, lowering rates. What we've seen is this evolution over time where they've been adding more to the bills to help lower and moderate income folks, expanding the child credit being maybe the most prominent example. But they're still not there. I mean, the tax plans out there at the moment are still very much ones that provide a larger tax reduction for high income folks than for lower and moderate income folks. And again, it's a moving target, and there are folks who are working hard to have it do more for low and moderate income folks. But really, this is not at the moment an undertaking or a plan that is leaning against rising inequality.
Oops. So I confess to real bias, which is going to come across in the question. $11 million, I think, is the aggregate amount that you can pass through as a couple before you pay estate tax. And yet the middle of the country seems to be against the estate tax. They're buying this death tax argument, even though they're not even close. Why do you feel like they don't say, yes, this is an opportunity? Why are they in favor of a higher ceiling when they've got no hope of getting there, I guess? And there's my bias. But.
Yeah, so my sense is that a lot of people think sincerely that the estate tax is unfair, that you've paid taxes during your lifetime, that the death of someone is a very sensitive moment, and that there is something sort of mean and grave dancing-ish of collecting the estate tax. Not saying whether or not I agree with that, but I think that is a perception that is separate from the dollars involved. Now, that gives me a hook to make one point about the House bill. And this is a little geeky, but if any of you were lucky enough to be doing estate planning and thinking about it. There's another feature of death and estates that's important, which is what happens to capital gains if you accumulated over your life. Because I just told the story that a lot of people think the income's already been taxed, why are you bothering me again with another tax? But there is this issue about, well, what if you've accumulated a lot of capital gains, you've held assets for decades, have those been taxed? And under current law, under the estate tax, they're not. You get what's called basis step up at death. So all the capital gains escape taxation as capital gains, but then they're subject to the estate tax. The House proposal would eliminate the estate tax, but not get rid of this basis step up. And so you'd actually have a bunch of income that never gets taxed. The basis would step up, and so there'd be no capital gains taxed, and in addition, there would be no estate tax. And that's a quite unusual, aggressive approach to dealing with estates. Some of you may remember that we eliminated the estate tax for a year back in 2010. And when that happened back then, they at least taxed the accumulated capital gains. So the basis carried over, and you couldn't escape the capital gains tax. And so that proposal on the House side is really quite out there, not something I expect that will survive what the Senate wants to do to it. Yep, I think, nope, nope.
Here, and
Oh,
then
I'm sorry, there's
just-
behind the post.
just shorter for me to walk.
So my understanding is that 20% corporate tax rate in your eyes is not a good idea. What about the permanent aspect of tax, well, corporate tax at 20%, or the idea that permanent and tax is used in the same sentence?
Oh. So now if you made me king for a day and let me design the US tax system, I might very well choose a corporate rate that was, 20. And my friends at the Tax Policy Center have done scenarios where you could make it even 15. But that requires that you pull on a bunch of other levers that aren't part of the conversation at the moment. Here's the reality, right? If you wanted to make the US tax system look more like the tax systems of other successful economies abroad, kind of step one would be introducing a value-added tax, which is the way many other countries raise a very large share of their revenue. And you could use some of that money to pay down reducing the corporate rate. Now, you'd have to do some distributional things as well to make everything work. So I think, which is my position, it's very hard for me to see how the math and the politics allow 20% to be possible in the end, given that the only way the Senate is able to get there is to make the tax cuts for ordinary people expire. So the politics are very tough. And forgive me, I filibustered on that and I forgot the second half of your question. Oh, permanent, right. So there's a fascinating discussion about what on earth permanent means in the context of the tax code. And I view it as being permanent means you've permanently changed what the bargaining position is. Because you should view this as a repeated bargaining game where periodically there's pressure, either political or because of some expiration, to examine things. We've seen in the past that temporary tax cuts have a tendency to persist. And so temporary tax cuts have a tendency to become permanent, but that's not a rule of law. So if you think about the tax cuts that were enacted in 2001 and 2003, originally under President Bush, the majority of those were ultimately extended permanently under President Obama, but not all of them, right? So some of the tax cuts that were focused just on the highest income folks were allowed to expire, and occasionally some other tax cuts expire. So, permanent means you don't have this debate in the future where they might disappear, and you also means you don't have this forcing mechanism to revisit them. Right? If the Senate bill were to pass in its current form with all these tax provisions expiring at the end of 2025, at the end of 2025, we would be having a giant scheduled tax debate.
So one of the interesting things about this current political climate for some of us is that we're spending more time trying to hear the other side. So I'll spend time listening to Fox or something like that just to get somebody else's opinion, perspective. And I heard one that I wasn't sure if I could understand it. I was wondering if you could help me. The person, the call-in speaker, or the person who was talking said, it's not a blue state, red state, like we're going to punish them on the deduction of the state and local taxes. It's that their state and local taxes are so high because they've created a very high level of liabilities with public pensions that we don't have here in this state. And why should I be in my state where we don't have those liabilities and we don't have those deductions? We think it's fair. I mean, they chose to make these liabilities. Why should the whole country bear the cost of those? I didn't know how to respond to that. In other words, they're saying you're in these blue state places where you gave away lots and lots of money due to public pension bargaining, and that's created massive liabilities. I've learned from Bob Posen, these numbers are really vast. Yet I don't know if that's the actual thing, because I'm not astute enough about all the pieces of that math. Could you comment on that?
Just that's the first I've heard that argument, so I'm making this up on the fly. I think a constructive way to think about the state and local tax deduction is that the federal government and federal taxpayers are essentially covering, for argument's sake, 25% of the cost of raising any taxes at the state level. Right, so if you raise income taxes at the state level, your state residents, your state citizens see their taxes go up, but those who are in a position to itemize and get the deduction get a bunch of that back, and so the net burden on them is going to be slightly lower, and so that can encourage the state to do more things. The part I'm struggling with here is that's a story about the state raising taxes to fund things it wants to do, whereas the pension brings in this additional unfunded piece. And so the thing that's not computing for me on the fly and may not have computed for you at the time of the conversation is it's not immediately obvious to me how the tax deduction for state and local taxes equates to the unfunded piece.
What's your take on how they are going towards reaching the goal of simplification? Will we really be able to pay less to our tax accountants?
So the pass-through thing is clearly a giant step in the other direction, right? Because all of a sudden you're going to need a whole set of rules to decide, are you a good or a bad pass-through, right? So that's a mess, right? Particularly if you believe my concern that it's going to spire gaming and there's going to be an arms race, and so the regs are going to be like this over the next decade. On the pro-simplification sides, there are a couple of things. So for small businesses, one of the things they do is they expand the availability of cash accounting, which I happen to think makes enormous sense for small businesses that if they happen to do their normal management on a cash basis, and they're relatively small, so like keeping tracks of things like, depreciation and amortization just, aren't a core part of managing their business. I think that makes a lot of sense because small businesses face a lot of compliance costs. So that's a check mark in the win box for simplification. And then for people, expanding the standard deduction, and even after you get rid of personal exemptions and whatnot, does mean that fewer people are going to be itemizers. It gets complicated with other changes they're making in the tax code. And also, getting rid of the state and local tax deduction, rolling back the mortgage interest. And so you're going to be in a situation where a significantly smaller fraction of individual taxpayers are going to have to deal with the trouble of itemizing. And that's a simplification gain. It reduces over time. Basically, there's a whole set of issues about what parts of the tax code get indexed to inflation and what measure of inflation it is. And because of some features of that, over time, the number of itemizers grows over time. But still, you're simplifying life for a chunk of taxpayers. Then there's also but then there are additional things in there. We haven't talked about. There's a whole issue about graduate students who get tuition waivers. And if they're graduate students who work as RAs and get a tuition waiver, one of the proposals out there is to tax that as a form of imputed income. Obviously, leave aside for a moment how you feel about whether that makes sense, but just note that that necessarily complicates the tax code because now you're going to need a whole system of tracking through what the tuition waivers are and getting those onto people's tax forms. And so I would say this is, a mixed bag on the simplification front. This is clearly not a highly focused on simplification, even though there are pieces of it in there.
I have a question. How much of the foreign money that's in the New York banks do you think would be released if we were down into a 20-25% corporate tax rate? And how much would that sort of affect and give us, and how much would that value of having that money to be used in the United States, and sort of a little bit about that?
Okay, great. Okay, so I'll go in the corner and whimper and cry about the international, but then I'm back. So the proposals out there at the moment, okay, so I have to step back and do a little bit of 101 on how we tax stuff. So imagine you're a multinational. You earn some money here and you earn some money in another country. There are three ways we could tax you. We could tax you only on the money you earn in the US. Okay, that's called the territorial system. We could tax you on all the money you earn, both here and in the other country. That's a worldwide system. Or you could choose door number 3, which is what the US has at the moment, and is we could tax you on both sets of income, but we defer the tax on the overseas income until you bring it back. Okay, and so that's the $2.5 trillion. So you owe tax on it, but it's nominally overseas, and so you don't pay tax until it comes back. Everyone has come to them, not everyone. There's a general realization that we have chosen the wrong door. And that we should choose a different door for our tax system. And so the goal at the moment in both of these plans is to move to a modified version of the territorial, where we tax your income here, we don't tax it abroad, but that's too strong because then you're creating all sorts of incentives to move income overseas, but you'd have a lower tax rate over there, but we'd get rid of this deferral thing. And so there'd no longer be the deferral, there'd no longer be the keeping money either literally or just, electrons overseas, that there'd be no distinction there. And so then the remaining issue is, well, what happens to the $2.63 trillion that's out there? And the tax plans would deem it to be repatriated. So they would say, we don't care what you do with it. For tax purposes, we're going to say you owe taxes on it. And I forget the number, but the spirit of it is, and we're going to let you pay it over the next 8 years. But then the debate is, what's the tax rate that I'm deeming your repatriation at? Right. Now, you might think it would be 35 or whatever, or 20. But the reality is that is a parameter that is being negotiated in these tax plans. And what you see typically are numbers, forgive me for forgetting the specific numbers, but you see numbers like 10% or 12% as the tax rate on the liquid stuff. And then you see a lower tax rates on the illiquid stuff, right? So if you have some overseas earnings that are in some very illiquid, hard to value, hard to sell thing, well, they still have to value it for this story, but there may be a lower rate applies to that. But basically the answer is that the 2 or 3 trillion overseas would be deemed to be repatriated so that we would never again have to face this issue of when or if it gets repatriated.
It's small numbers. It's only going to be like 2.5, 200 or 300 billion.
Yeah, exactly, yeah.
No, I mean, because 10% of 2.6 trillion, 260 billion.
Oh yeah, part 2, yes. So the best evidence is that it wouldn't have much macroeconomic effect because, so money is largely fungible, not completely, right? So it does matter in some situations that the money is labeled as overseas money rather than domestic money. But the reality is that that money, so I said it's sitting at a bank, but of course that means it's invested in something somewhere. And so if you relabeled and brought it back, you know, you can certainly find, you can imagine situations in which that would affect the cash available to make some domestic investment. But the evidence from when we've done somewhat similar things in the past suggests that by and large it doesn't have a big macro effect. That basically mostly firms are able to work their way around it at the moment. You know, it's not a perfect system. There's some downsides and some frictions, but don't expect a giant boom from bringing it back.
All right. Well, thank
Well, thanks.
you. And I tell you, didn't Jim and I tell you, taxes are fun.